Good morning, good afternoon, good evening, depending where you are on the planet. And welcome to the Monday, the 18th of July, Bull versus Bear webinar. Steve Miley on the call for trade day. Welcome, everyone. We're going to go through pretty much our usual regular run through. Slight tweaks in here today. We've obviously got earnings calendar to look at in a little more depth. Monday, as you know, I used to tend to look at the shape of the week. What do we mean by the shape of the week? Well, looking out a bit further, yes, trade day is a day trading challenge. It's a day trading platform, and we're encouraging you to trade within the day and close out at the end of each day. It doesn't mean that you shouldn't be aware of what's coming up in the week, because if we have, for example, a lot of events scheduled for the second half of the week, it might mean that the first half of the week is going to be quieter, less volatility. You may slightly adjust your trading style. You may slightly adjust your the amount you're putting on trades. You may adjust your stops, your targets because of that. Okay, and it's good practice anyway. You should know what's going on in markets and have an understanding of how that might be impacting you now, even though the event's not occurred yet. So let's take a look at. We will take a look at the calendar, not just for today, but for the week, both on the macro side, the macro fundamental side, what are central banks doing, what data are we expecting that's significant that are going to impact the markets that I know you guys are trading, which is mostly the NASDAQ and the S&P, and oil and gold. A little bit of treasuries we have people trading as well. So we'll take a look at all of that on the calendar, the macro calendar. We'll also take a look at the micro calendar being the earnings calendar. Might remember macro being big, macroeconomic, the big economic data, the micro being small, the smaller economic data, the earnings data, the individual company data that is coming out, because if the bigger stocks in the indices can have an impact on their sector. So, for example, if Apple does really well, it has a whole impact on the sector, and then that can have a significant impact then on the tech sector, and then in turn on, say, the Nasdaq, or in turn on the S&P, or on the Dow Jones. So we will be looking at the micro calendar, the earnings calendar as well. And then we'll take a look at the articles from the major news wires, what's going on the macroeconomic fundamental geopolitical side right now that's impacting markets, and we'll probably only get a real quick look at the charts. I won't go into depth like I sometimes do, looking at some more in-depth technicals. It'll be a lighter look at the charts today. Right, a little recap. Remember, I post this each day in the trading room. Not each day, correction. I post this on the weekend, usually on the Sunday. It was out yesterday afternoon, US time, yesterday evening, European time, and this is the Trade Day Weekly recap and update. So effectively, what it is what happened last week, what happened in the actual on the macroeconomic geopolitical side, what were the financial market developments last week, and what are the key things we're looking for this week. So looking back last week, we had the US CPI data. It was the big event. It was the print much larger than anticipated. 9.1 it came in, up from 8.6 in May, bigger than the consensus. We also had then a move towards, and we had a backing off of this at the next Fed meeting, which is only a week and a half away now, a move to the short-term interest markets pricing in a 1% hike. We're going to look at that as we go forward, because that's starting to not get priced in so much now. The US 2-10 yield curve inverted even further, a recessionary signal. Now, it already inverted early this year, and given that signal, but last week moved to its most inverted since 2000. So certainly a very negative inversion from the yield curve, telling us we're heading towards recession. Last week, the Bank of Canada increased their rates by 100 basis points, a full percentage point. The consensus was only 75. So it's not just the US, it's not just the Fed. Global central banks are becoming even more hawkish than markets anticipated. And then US earnings season kicked off last week. JP Morgan and Morgan Stanley both disappointed. Wells Fargo was kind of in the middle. Citigroup was a positive. We've got more earnings coming up. We'll talk about that. But despite most of this news up here, most of these major impacts in here being negative, a lot of this has got priced in. US stock averages, European and Asian equity indices are all starting to show more positives. Last week we saw, yes, US stocks I think were lower slightly on the week. They're pretty much unchanged on the week, but they went notably lower the first half of the week. They went lower, they spiked lower on the US CPI print, and then came back stronger into the end of the week. Markets are forming bases. Now, remember, with a bear market, which we've gone through, for the first half of this year, the S&P 500 was down more than 20%. So that's officially a bear market by most measures. a lot of time the bear market bottoms take a time to form, and it certainly looks to me like we've been forming one through May, June, July. Certainly through the second half of June into July, we've been in a sideways consolidation with most of the indices, and now starting to signal a better basing structure. We'll talk about that when we do jump to the equity, to the charts in a little bit. US yields went back below 3% into the month, into mid-month, with lower yield activity continuing. We've had lower yield activity since the FOMC last hiked rates. Lower yield pressures. Where are we? If I can zoom down in here, we'll see that. There's the yield chart. Look, yields have been falling since the last rate hike. Yeah. So since the last rate hike, since all this more inflationary news, since we've had the Fed becoming even more hawkish, long-term interest rates have been going down, and they were down last week as well, back down below 3% in the US. What else have we had going on? The dollar continued to be strong last week. Okay, for most of the week, broke the euro versus the dollar went below parity. Dollar yen went to a new multi-year high. But oh, and I'm just going to say as well, gold went lower, oil went lower, but then did rebound. Copper went lower as well. What I want to point out here, guys, is I think this is really, really, really important. If you look at my daily updates, right, I've been bullish the dollar for weeks and weeks and weeks. Most days, bullish the dollar for weeks and weeks and weeks. Okay, and I can't go and get the daily update chart. Actually, no, I can't. I won't be able to. If I go and get it, we're going to listen to me. You'll hear the reverberation. We don't want to hear that. But if you go and look at the daily chart, the daily update, the daily technical analysis chart. Sorry, not the chart, the report. I've been bullish the dollar. You know, on these webinars, I've been bullish the dollar, staying bullish the dollar. The dollars continue to go higher. At the end of last week, the Australian dollar looked more positive against the US dollar. The New Zealand dollar looked more positive. The dollar against the Canada, the US dollar looked more negative, so Canada positive. Even the euro, which is under massive negative pressure, even the yen, with dollar yen surging higher, dollar yen started to roll over. The euro started to put a little base in. The pound, even, which has been under lots of negative pressure, started to put in small bases. And this morning, we're higher again. Most currencies, the euro is now putting a small base against the dollar. The pound has started to do that. The Australian, New Zealand dollars are actually starting to get now higher highs and higher lows. What it's telling me is now the dollar has turned, right? The equity markets have been trying to turn. The problem we've had in the last, I would say, 2 to 3 weeks is markets have been sending, different asset classes have been sending different messages. The dollar stays strong. We spoke about bonds there. Bonds have been trying to go to lower yields, but they're not quite sure. They went higher in yield 2 weeks ago, back lower in yield this week. We've seen inflationary pressures ease a little bit with respect to commodity prices going lower, but commodity prices now start to turn. Oil has turned and put a base in. Remember last week we were looking at that inverse head and shoulders on the oil chart, right? From the setup that we've had from June. So it's been, I'd say, since Thursday, Friday last week, and certainly by Friday, before we went into today, and my reports reflect this, we're shifting more back to a classic risk on. Risk on being when traders, investors are willing to take more risk. So they buy more risky assets. So stocks are trying to put in a base. Equities, they're riskier assets. The Australian dollar, the New Zealand dollar, the Canadian dollar, these commodity currencies, they've started the turn against the dollar. They've led the turn ahead of the G3 currencies, G3 being dollar, euro, yen. Yeah. But even the euro has turned today. Yeah. It started to turn. It rebounded on Thursday. Post CPI went lower, then rebounded. And then on the euro, then euro went higher, slightly higher on Friday. And today we've got an above the high from last Wednesday on euro. And now we've got a base in the euro versus the dollar. What I'm trying to say here, guys, is we've certainly seen a shift to a more negative dollar since about Wednesday, Thursday last week. And it's really been reinforced by this morning's price action. What we're seeing the oil price push higher again this morning, securing that inverse head and shoulders. We'll look at some of these charts. What we're seeing, we've even seen some of the commodities started to rebound better in here, right? The other commodity markets. What it's showing is a broader move across asset classes to risk on. And equities have been trying to do that, been going sideways, trying to do that. But I think other asset classes have been making the equities unable to produce really more positive, more bullish risk on signals. But I think we're getting close now. I really do think we're getting close. And I wouldn't be surprised for this week to be a more aggressive risk on week. Okay. That is stocks higher, dollar weaker. I'm not 100% sure where that takes treasuries. I think the treasuries are actually go back to higher yields, lower prices, higher yields in that scenario, potentially. Okay. And commodities trying to rebound. You might see oil back higher again. Right, just carrying on with this though, going into this week, we've got most of these central bank won't really interest you guys, but we've got the Reserve Bank of Australia meeting minutes tomorrow, People's Bank of China decision on Wednesday. That could be important. Bank of Japan have been doing nothing. ECB is the most important on that list. ECB haven't increased rates yet. They're expected to increase rates yet. We're fully expecting that. If they don't, it'll be a super dovish stance. I cannot believe, and they're not going to not. They will raise rates, but it'd be interesting to see what the ECB say on Thursday. On the data front, we do get a whole raft of data. The most important data is the global flash PMI data we get from S&P Global. That comes out at the end of the week on Friday. Okay, this flash PMI data is probably the most important data we have of the week. From your guys' perspective, we do get a load of UK and European inflation reports, employment report from the UK in here. That may have a little impact on markets, so we will be keeping an eye on those as well. Okay, if I step to the actual daily calendar in here, there's nothing in here, nothing of any real note. RBA meeting minutes, as I've already mentioned, get them overnight tonight. What else do we have? So here's have a look at the earnings calendar. So we're getting ready to full swings. Kicked off last week with the financials, into full swing this week. Bank of America reported in here today. You can see they're in red. We've had a miss already. Okay, IBM we get today after the bell. Charles Schwab, I don't think we've had yet. Goldman Sachs beat. Okay, so we've got a beat from Goldman. We've got a miss from BOA. Okay, so a kind of mixed bag there. IBM later. What are the big ones today? This week, well, actually, if I go back in here, you can see I've got them listed out. The big ones: Bank of America already. IBM, Goldman Sachs, we've already mentioned. We've got Johnson & Johnson, Netflix, Tesla, and Twitter all coming this week. Okay, probably the standout there, Netflix and Twitter. Netflix and Tesla. Netflix tomorrow, Johnson & Johnson, big part of the Dow, so you're watching out for that. Netflix, we'll keep an eye on certainly tomorrow. A reflection, and remember, of the US/global consumer. Yeah, it's seen as a big consumer stock. Is the consumer getting worried? Are they starting to cancel their Netflix subscriptions? Is the growth in Netflix not as big as it has been because of concerns about a future recession globally? So we'll certainly be keeping an eye on Netflix. Tesla's another big one we need to be keeping an eye on as well for the whole kind of new era tech kind of sector in here. What else do we have? You've already mentioned. So we actually get AT&T, Philip Morris, Union Pacific later this week, and Friday Verizon, American Express. Next week, then we get a load of the big tech. Okay, the likes of Apple, Google, Microsoft, etc. Doesn't come till next week. There's Twitter down there. We have Twitter on Friday. Okay, so that's all important. Let me run through what we've got going on the macro fundamentals. So we're not going to get much chance to get through the charts today. 5 things to show today. The dollar capital is vertiginous rise of the past year by rallying another % last week. Okay, but as we said, I think the dollar's rolling over. I think the dollar really is rolling over. International investors love China's all but disappears. They say reasons to avoid the country outweigh incentives to buy. Yeah, so China's stock's not doing too well in here at the moment. The zero COVID policy not helping at all. European Central Bank about to restore its credibility. Financial got a whole lot harder. Okay, it looks poised to raise interest rates this week at last. Okay, and then the problems with the energy crisis. Not really much in here today. European stocks and US futures higher this morning, and so continuing the rebounds that we've seen. And again in here, if we look, there's nothing really in there. So we've got European stocks in here this morning. Take a look at those. All higher, 1.5% to 2% up on the European stocks. If I come across here, I think we've got okay, yeah, they go. Futures rise as rate hike bets ease. We're going to come to that in a minute. Bank earnings are weighted. We've already had both of those in here this morning. And if we look at the US stocks going into this morning, up about 1%. Nasdaq's up 1.25% in here this morning. So all looking fairly healthy on that front. And again, in here, let's go to Bloomberg. Stocks climb, futures on receding rate bets. We're going to come to that when we look at the Fed tool in a second. Okay, receding rate bets. This could be start of a dollar doom loop. A reverse currency war beckons. Okay, that's worth reading. I haven't looked at this yet, guys. I think this is an article worth reading in here. What else we have? Oil advances back towards $100 with markets in risk-on mode. We've already spoken about that. And just for completeness, Bitcoin as well. We haven't spoken about crypto, but cryptocurrencies, they're aligned with risk. They go up when we're in risk-on mode, and we're seeing the cryptocurrencies moving higher today. Ether as well, and Bitcoin back above 22,000, and we've already taken a look there. And then also from Forex Live in here, same thing, risk on. European stocks hold solid gains, US futures higher as well in risk on mode. And then if we go and take a look at currencies, cable climbs on 1 week high amid softer dollar, better risk move. So we're in risk on mode in here at the moment, and that risk on mode in here is meaning weaker dollar, stronger stocks. Okay. Look, this is really interesting. Remember where this was last week? This spiked all the way up here. I've got it on the other chart, on the other tab in a minute. But this is the Fed Watch tool showing the risk of 100 basis point, right? After the Fed meeting minutes. Sorry, after the CPI. Excuse me. I'll recap that. After the CPI date on Wednesday, this spiked massively higher for nailing on almost 100 basis points. We've gone back to the best chance now, 75. Yes, there is still a third chance of a 100 basis point hike. If we go and take a look here, this was last week. You can see this in here. It spiked up on Wednesday to Wednesday/Thursday up to 80, right? And now we're back at down to 30. So having rushed into a threat of almost nailing on a 100 basis point hike, we're now receding back to there being just a chance now of a 75, back to where we were. Okay. Right, I'm going to very quickly go through these guys, but we've got some really important levels coming up on the top side. Nasdaq's getting close to not only this high here, this high's here. Okay, we've already spoken about this bottoming, higher highs and higher lows. Now, if it takes out this high next, okay, well, I don't think we're there yet, right? High at the moment, 12,180. Higher here, 12,211. Higher here, 12,262. Through 211, through 262, creates a better base. This thing could fly on the upside. And it's the same on the S&P. Okay, look, we're right in here close. Okay, today's high, 39.09.5, peak there. 39.22, peak here. 39.50. Through 22, rallies us up to 50. Through 50, an even better basing pattern. And on the 15-minute charts in here, no reason to expect, look, higher. There's that, remember the inverse head and shoulders? Down here, we spoke about that at the end of last week. Boom, 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 boom. Taking out all these resistances now, challenging. And look, we've had a little dip in here this morning in European time and back, nudging towards the highs. And same here, this is a 30-minute chart on the NASDAQ. We get this double bottom or maybe inverse. We spoke about this inverse head and shoulders in here as well. And then Friday up again this morning. There's the high that I've already mentioned. And look, a little dip and a rebound this morning. This is all looking very, very bullish. Okay. Where are we? On oil, we spoke about, there's the 15-minute chart on oil, actually. There's the inverse head and shoulders on oil we spoke about last week. We've completed that inverse head and shoulders. We've had a spike lower in here. Right now, it's spiking lower. I think this is maybe a buy opportunity on oil. I still think oil eventually goes back lower, but I think you have to think about this is going up because we're in risk on, right? So it's being bought risk on, not maybe as bad as a global recession. So buy oil. So I think you wait for this to turn now and catch the next move higher on oil would be how I would approach that. Let's go take a look at gold now. Despite the fact that the dollar, so actually look, the dollar. Go take a look at the dollar index here. So there's that turnaround. There's Thursday. So there's the CPI data. There's Thursday. We managed to go high. You have this failure candlestick, right? This is a shooting star. And it's only nudged a bit lower on Friday. But look, down through Wednesday's low now. Okay, down through Wednesday's low already on the dollar index. This looks like a reversal. This looks like it's pushing lower, which puts us in a bit of a quandary with gold, because gold looks like, it was still negative Thursday, negative Friday. It's tried to rebound today and stalling. But gold should go back higher with a weaker dollar, right? If you go to the 30-minute chart, look, but it's stalling. I think you look to buy. I think this is a basing on gold. I think this is a base going in. And I'd probably be looking to buy gold on the next turn, okay? But it's a tricky one to go because it's not really giving us the signal yet on gold. We did break through this trend line, not the best trend line. But nevertheless, you've got higher highs and higher lows now. This is on the 30-minute chart. If it holds this low here, the low from overnight has been 1710. If it can hold 1710 and swing, then you probably want to be buying into gold. Well, that's my view anyway. All right, I'm going to wrap it up there, guys. I'm going to wish you all a great trading day. Please do stay safe out there. I'll be back with you with another Bull versus Bear webinar tomorrow. Bye.